Alright, Nathan Thomas from Avondale, Arizona asks, I already have a fixed interest rate. Can I still get a loan modification? Simple answer, Nathan, is yes, you can. Basically what the banks are looking for is the ability to make a modified payment. So if you're having trouble making your mortgage payments and you can make a modified payment, you might be eligible for a loan modification. You might be asking now, how'd they modify my mortgage if the rate is already fixed? There's a couple ways that they do it. It's the same ways that they would do it for an adjustable rate loan. Basically, they would lower your interest rate potentially. They could extend the length of the loan, or they could lower the principal balance. So like if you're at, let's say 7% on a 30-year fixed, it's not necessarily a volatile loan, but if your loan or if your mortgage payments are too much for you to make, they might lower that interest rate to 5% on a 30-year fixed and keep everything else the same, but it give you some payment relief so that you can make a modified payment. Or they might keep you at your 7% and extend your loan to 40 years, which would amortize the principal over 40 years and drop your payments down a little bit. Basically, there's several different ways to adjust the payment threshold on a loan. So just because your interest rate is fixed doesn't disqualify you automatically from having a loan modification. The qualifications that they're looking for is can they make a modified payment if we modify their loan down. That's essentially what they're looking for. So the reasons why a bank would modify a fixed loan are to keep homeowners in their home and avoid the cost of foreclosure. A lot of people don't realize that it costs a bank upwards of $70,000 to foreclose on a home after all of the attorney's fees, the auction costs, the selling the new home, any kind of repairs that they have to do if they do those kind of things, legal fees, I think I already mentioned that. It costs the bank a lot of money to foreclose on a home. So if they can keep the homeowner in their home and avoid the loss of foreclosure, then they're all for it. Another reason is that they would mitigate a loss on an investor money. So essentially how it works is there's pools of investors that invest in bulk batches of mortgages. Okay, and if a high percentage of those mortgages go into default, those investors lose their money. And to mitigate that loss, most investors would rather make 5% on their money than no money at all. Another reason is to balance their investment portfolio and increase the stability within their organization. If a bank has a high percentage of foreclosures, they run the risk of all kinds of administrative problems. We've actually seen this in quite a few different banks that have closed up while COVID, obviously selling out to Wells Fargo and such. The reason why is because their investment portfolios are so upside down that they have a negative equity in their organization, and other companies are able to acquire them. So I hope those answer your questions. That's why a fixed rate mortgage is still eligible for a loan modification. If you like this video, check out easyhomeloanmod.com/20-free-videos, and I'll hook you up with 20 more videos teaching you everything you need to know before you get involved with a loan modification. And I hope this helps. Thanks.